You get your paycheck, you see the amount, you're happy. But by that moment, the system has already taken its cut. You're getting maybe 55 cents on every dollar. The rest was gone before you even opened your banking app. Most people live in this illusion their whole lives. Matt, an architect, lived in it for 3 years. 3 years isn't just an abstract amount of time. It's 1,000 days. 1,000 days of Matt walking into his downtown Chicago office, spreading blueprints across his wide desk by the window, and doing exactly what was asked of him, and then a little more. He was the kind of guy who couldn't do anything halfway, not because he was afraid of getting fired, but because he just didn't know how to. An architect either sees the whole building or he doesn't see it at all. Matt always saw the whole thing. The firm he worked for focused on commercial real estate. Not the most glamorous sector, no cultural centers or conceptual residential districts. Strip malls, corporate parks, logistics terminals. Matt didn't complain. He understood that in this profession, you first build experience, then reputation, and only then do you get to choose. For 3 years, he built experience. His starting salary was $75,000 a year. After taxes, that was about $4,700 a month in take-home pay. He accepted it calmly. He rented a room in a 2-bedroom apartment up in Lakeview, made a budget spreadsheet on his phone, and started living by the numbers. Groceries, $400. Rent, $1,200. Transit and Uber, $200. Phone, subscriptions, utilities, another $300. Total, $2,100. He had $2,600 left over. It wasn't wealth, but it gave him room to breathe. A year and a half later, he moved into his own 1-bedroom place. Rent jumped to $2,200. The air got a little thinner, but Matt wasn't worried. He was already managing 3 standalone projects and knew a conversation about a raise was just a matter of time. He didn't push. He waited for the moment when the numbers would speak for themselves. That moment came in early November. His director, David, called him into a conference room, a small space with glass walls that always smelled like stale Keurig coffee and new plastic chairs. David sat down, opened his laptop, and turned the screen toward Matt. It was a spreadsheet, projects, deadlines, performance reviews. Next to Matt's name, everything was marked in green. David said, "We've decided to bump your salary. Starting December 1st, $100,000 a year." Matt nodded. Something shifted inside him. Not an explosion, just a quiet, almost physical relief. Like when you've been carrying something heavy for a long time and finally set it down. He said thank you, shook David's hand, walked out into the hallway. That evening, he called his mom. She was more excited than he was. "Finally," she said. "I knew it. I'm so proud of you." He smiled, standing by the window of his apartment, looking out at the city lights. Then he opened his budget spreadsheet and started recalculating. $100,000 a year. After federal tax, Illinois state tax, and FICA, that would be roughly $5,800 a month hitting his checking account. Minus his $2,200 rent, $500 for groceries, $250 for transit, $300 for phone and subscriptions, $100 for the gym, and maybe $400 for household items and clothes. Total expenses, $3,750. The remainder, over $2,000 of pure disposable income. For the first time in a year and a half, he was seeing that kind of number in the free cash column. He locked his phone and went to sleep, feeling like things had finally fallen into place. December went by at a standard working pace. The new paycheck hit on the 15th and the 30th. It added up to $5,800, just as he calculated. Matt paid his rent, bought groceries, covered all his usual expenses. His leftover cash at the end of the month was $1,600. A little less than he projected, but December is the month of office parties, holiday gifts, and extra spending. He wrote it off as holiday noise. January. Remaining balance on the 31st, $1,100. Matt frowned. He opened the spreadsheet, scrolling through the rows. Nothing unusual. Same categories, roughly the same amounts. He figured January was just post-holiday hangover. People always spend a bit more. February would show the truth. February showed $1,200. March, $1,050. Matt sat at his kitchen table on a Sunday evening, phone in hand. On the screen was the data for the last 3 months. He scrolled up and down, as if reviewing a blueprint looking for a structural flaw. The numbers didn't lie. His expenses were almost exactly the same as before the raise. His take-home income had grown by $1,100 a month. But his actual free cash had only increased by maybe $300, sometimes less. He grabbed a piece of paper, an old habit from college when a project wasn't adding up, and started writing in columns. Old salary, $75,000. Gross, approximately $56,400 net. New salary, $100,000 gross, approximately $69,600 net. Difference, $25,000 gross, approximately $13,200 net. He stared at that difference and felt something akin to vertigo. That light, unpleasant dizziness you get when you've been staring at a floor plan for hours and suddenly realize the staircase leads nowhere. That extra $1,100 a month was supposed to change his life. In reality, his life changed by about $300. The rest just vanished. Not on anything specific, just vanished. He closed the spreadsheet, put his phone face down. Outside it was March, gray, with dirty slush still clinging to the bumpers of parked cars. Matt looked out the window and thought about how he'd waited 3 years for this raise. For 3 years, it felt like the ultimate solution. And now he was sitting at the same table, with the exact same end-of-the-month anxiety, just with different digits on the screen. Something in this story was rigged. He just didn't understand what yet. Maria had been cleaning the firm's offices for 7 years. She'd come in at 6:30 a.m., when the office was completely empty, park her cleaning cart by the wall, put in a single wireless earbud, playing music so quietly you couldn't hear it, and start from the far end of the hallway. By 8:30 a.m., everything was done. She never got in anyone's way, and nobody really noticed her presence. The floors were just dirty, and then they were clean. Matt sometimes crossed paths with her by the coffee machine if he came in early. She always said good morning first, quietly, with a slight nod. He'd reply. Once she asked if the new building on Michigan Avenue they were designing was really going to have an indoor winter garden. Matt was surprised she even knew about the project. "I hear you guys talking in the conference room," she said. "It just sounds interesting." He explained the atrium and the skylights. She listened carefully, nodded, then grabbed her cart and moved down the hall. In mid-April, something glitched in the HR software. Matt walked over to HR to sign some paperwork for a non-disclosure agreement on a new project. He found Linda, the payroll manager, frustratedly sorting through a stack of physical pay stubs they had to print as backups. Linda stepped out to take a phone call, waving her hand at him. "Give me a sec." Matt stood by the desk, looking out the window. Then his eyes accidentally dropped to the top sheet of the stack. He didn't mean to snoop. He just saw the numbers. The name was Maria G. Base pay, $1,346.15, biweekly. Gross pay, $1,346.15. Taxes withheld, $285. Net pay, $1,061.15. He stared at the paper for a few seconds. Then, almost automatically, the way anyone with an analytical mind does, he started doing the math. If she gets paid every 2 weeks, her salary is roughly $35,000 a year. The company deducts federal, state, and FICA taxes. But that's only what the employee sees. How much does the employer pay on top of that? In employer payroll taxes, unemployment insurance, and workers' comp. Linda came back, scooped the papers into a folder, and signed his form. Matt walked back into the hallway. He pulled out his phone, opened Safari, and searched. Employer payroll burden in Illinois. He read it twice. On average, an employer pays an additional 20% to 30% on top of an employee's base salary for mandatory taxes, Medicare/Social Security matching, and bare-bones benefits. On top. That meant for Maria, who makes $35,000, the company is actually spending roughly $43,000 a year. Maria takes home about $27,500 a year after her own taxes. The difference is $15,500. That is more than a third of what the employer actually pays for her labor. Matt stopped dead in the middle of the hallway. The conference room door clicked shut behind him. A junior architect walked past with a roll of blueprints. Matt didn't move. He ran his own numbers. His salary, $100,000. Employer burden, payroll taxes plus their share of his health insurance plus 401k match. Roughly 30%. That's $30,000 on top. Matt's real cost to the firm, $130,000 a year. What hits his bank account? $69,600 a year. The difference? $60,400 every single year. That was money the employer was paying for him, but which Matt never saw, never held in his hands, and until today, never even considered his own. He walked back to his desk, sat down, and put his phone in front of him. The screen still showed the breakdown of payroll taxes. He read it slowly. FICA matching. FUTA. SHUTA. Health insurance premiums. Out of every $130,000 the firm spends on Matt, he sees $69,600. The government and the insurance providers take $60,400. Nearly half of his actual labor value. He sat there, staring at the screen. Then he remembered the conversation with David in November. The spreadsheet with the green check marks. We've decided to bump your salary. $100,000. Matt had heard one number. Just one. And for 3 months, he lived with the feeling that something wasn't adding up, but he didn't know where to look. Now he knew. He had never seen the full picture. He was given a single number, the gross salary, and he built his entire financial reality around it. It was like being given the floor plan for the lobby and being told, "Here is your building," while 3 underground levels were completely hidden from view. But that was just the beginning, because then he remembered the bank. When he started at the firm, he set up his direct deposit with a massive national bank. He opened his banking app, went to his statements, and started scrolling through the transactions for the last 3 months. Not his spending, but the deductions that hit on the exact same day his paycheck landed. He'd never noticed them before because he only ever looked at his ending balance, not the cash flow. Monthly maintenance fee, $12. He knew about this, but usually it was waived. Why was it hitting now? He checked the terms. He hadn't set up a qualifying minimum balance correctly when he switched his savings around. Then he looked at his actual pay stub in the HR portal. Supplemental life insurance, $45 per month. FSA contribution, $100 per month. Matt froze. He scrolled back. Same deductions last month. And the month before, he didn't remember signing up for supplemental life insurance or an FSA, flexible spending account. He opened his HR profile. Under benefits elections, it said, status, activated on December 1st. That was the day his new raise took effect. He sat there looking at the date. December 1st. When he got promoted to a senior role, the HR system automatically opted him into a senior tier benefits package. Unless he actively opted out within 14 days, the deductions kicked in automatically. He never read the 40-page PDF HR emailed him. That wasn't the only place the money was draining out. His silent, automatic monthly leaks. $12 to the bank, $45 for insurance he didn't need, and $100 trapped in an FSA he wasn't using. That's $157 every month. In 3 months, nearly $500 just vanished, without a sound. On the day the money hit his account, a chunk of it was already gone, quietly, automatically, while he stared at the deposit amount thinking he had received everything he earned. Matt closed the app. He looked out the window. It was April now. The trees were just starting to bud. He thought about how he'd spent 3 months trying to figure out where his money was going. Building spreadsheets, cutting grocery bills, looking for logic. But the money was leaving before he even got to touch it. The system processed it first, without his active participation. And the strangest part was, it was all completely legal. Ryan had been in Matt's life since college. They took a few macroeconomics electives together. Back then, Ryan seemed like a weirdo. While the architecture students argued over facades and load-bearing walls, Ryan was reading about tax codes and asset depreciation. After college, Matt went into design, and Ryan went into a financial consulting firm, working as a CPA. They saw each other maybe once a year. In late April, Matt texted him first. Not with a specific question, just, "Been a while, need to talk." Ryan replied instantly, "Saturday, coffee shop in the Loop, 11 a.m. They sat by the window. Ryan drank a black Americano. Matt got tea, even though he usually drank coffee. He just didn't want anything overly harsh that morning. He told Ryan about the raise, about the 3 months of waiting, the spreadsheets, Maria the cleaner, the hidden payroll taxes, the HR opt-ins, the bank fees. He spoke calmly, without emotion, like reading the parameters of a structural load test. Ryan listened without interrupting. When Matt finished, Ryan stared into his cup for a few seconds. Then he said, "You only found the first floor. There's a basement." Matt put his cup down. Ryan pulled out his phone and opened his notes app. He explained slowly, without rushing, like a man who had given this exact lecture 100 times and had long stopped being surprised by people's reactions. "Let's start with what you already figured out," Ryan said. "Your salary is $100,000. That's your nominal rate. The number they show you to make you feel good. Then there's the fully loaded cost, the $130,000 the company actually pays to keep you at your desk." Matt nodded. "Now look at your take-home pay, $69,600. That's your effective rate," Ryan continued. "If the business is spending $130,000 on you, and you get $69,600, you are effectively yielding about 53%. For every dollar generated to pay for your existence at that firm, you see 53 cents. The other 47 cents are gone before you even unlock your iPhone." Matt stared at the screen. Outside, people were walking by. A guy on a bike. A woman walking her golden retriever. A normal Saturday. Matt asked, "Is that even right?" Ryan half smiled. "Fully legal. It's not a scam or a gray scheme. It's just how the plumbing works. The government funds Medicare, Social Security, and unemployment through this. The question isn't whether it's legal. The question is, Did you know this when you signed your offer letter and planned your life? Matt didn't answer. Ryan kept going. Now, let's talk about debt. You have a credit card with that bank? Yeah, Matt said. Got it 2 years ago. $10,000 limit. I use it sometimes. Do you always pay the statement balance in full? Matt thought about it. Mostly, but there were a few months I rolled the balance over when I bought a new Mac. Ryan opened a new note. This is where the real mechanics kick in. When you carry a balance, the bank charges interest. The standard APR right now is anywhere from 24% to 29%. That's the nominal rate. But credit cards use compound interest. You know how that works? In theory, Matt said. Simple interest is calculated on the principal, Ryan explained. Compound interest is calculated on the principal plus the interest that already accumulated. If you owe $3,000 at 28% APR, the first month they hit you with the interest. If you only make the minimum payment, the next month's interest is calculated on the new, higher balance. The debt doesn't grow in a straight line. It curves upward. You end up paying interest on your interest. Matt took a sip of his tea. It had gone cold. And the last thing, Ryan said, amortization. You ever had a car loan? Yeah, 3 years ago, Matt replied. Used Honda, $18,000 over 5 years. Remember how the payment was calculated? Same exact amount every single month, right? Yeah, about $350, Matt said. That's an amortized loan, Ryan nodded. Sounds super convenient and fair. But under the hood, it's front-loaded. In the first 2 years, the vast majority of that $350 is going entirely toward interest. Only a tiny fraction goes to the principal, the actual car. By the end of the loan, it flips. Do you know what that means? What? It means if you decide to be responsible and pay the car off early in year 3, you don't actually save that much money. The bank already extracted its profit up front. You're just paying off the metal at that point. Matt put his cup down. He looked out the window. Then he asked quietly, "Why doesn't anyone explain this when you sign the paperwork?" Ryan answered without missing a beat. "They do. It's in the loan agreement. Page 6, paragraph 4, 2, in 8-point font. The amortization schedule is legally attached. The law is satisfied. The information is disclosed. It's just that nobody reads page 6 when the finance manager is smiling, handing you a pen and saying, 'Sign here and the keys are yours.'" They sat in silence. The L train rumbled somewhere in the distance. Matt asked, "What do I do about the HR deductions?" "Opt out," Ryan said. "Go into the portal on Monday. Cancel the supplemental life insurance you don't need. Adjust your FSA. It takes 3 minutes. It's your legal right." Matt pulled his phone out, logged into his bank app, found the account settings, changed his minimum balance threshold to permanently waive the $12 monthly fee. "Done," he said. $12 a month plus $145 in HR deductions. That's $1,884 a year. Money that was vaporizing for services he didn't choose and didn't use. Ryan watched him calmly. "This doesn't mean the system is evil," he said. "It just means the system has rules. And the people who know the rules pay less. Not because they found a loophole, because they actually read the blueprints before they start building." Matt put his phone in his pocket. Outside, the April sun finally broke through the downtown high-rises, casting a narrow strip of light across their table. He thought about how he had spent 3 years building his professional expertise, learning how to read structural blueprints, spotting load-bearing flaws, seeing the building as a whole. But he read his own finances like a freshman architecture student who looks at a glass facade and thinks that's the entire project. The waiter cleared their cups. Ryan put his jacket on. Before leaving, he said just one thing. Go home, pull your W-4 tax form, and look at your withholdings. Stop giving the IRS an interest-free loan every year just to get a refund in April. Matt said, I will. He did it that very night. Tyler was Matt's younger brother by 4 years. He worked in construction management, not designing, but actually out in the field doing site inspections. Hard hat, neon vest, standing in the mud. He liked the job because it was binary. Either the concrete pillar was poured straight, or it wasn't. No ambiguity. In early May, Tyler called Matt. His voice was elevated, faster than usual. I got a new offer, he said. Massive developer, $85,000 base. I was making $60,000 before. Matt congratulated him. Finally making real money, Tyler said. Gonna start saving. I want to finance a new Tacoma next year. They agreed to meet on Saturday. Tyler wanted to show him the offer letter, just to see if everything looked standard. He'd never asked Matt for advice like this before. Matt thought maybe things were changing. Tyler showed up with the printed offer letter. He opened it to the first page. Look, $85,000, 401k match after 6 months, full medical. Matt took the document. He didn't read the first page. He flipped straight to the appendices at the back. Tyler looked at him with mild confusion, probably expecting his older brother to glance at the salary, nod, and say, "Looks great." Matt read in silence. Tyler pulled out his phone and started scrolling. In Appendix B, Matt found the section on company benefits. Standard 401k auto-enrollment at 3%. But right below it, in fine print, employee will be automatically enrolled in the premium PPO health plan and short-term disability insurance effective day 31, unless a waiver is signed in the employee portal. Combined estimated deduction, $240 per pay period. That's $480 a month. Matt put the paper down, looked at Tyler. Tyler glanced up from his phone. Did you read Appendix B? Matt asked. Yeah, skimmed it, Tyler said. Just standard HR stuff. Matt slid the paper over and put his finger on the auto-enrollment paragraph. Tyler leaned in, read it. Then he said, Well, I mean, it's optional, right? I can just change it. Will you? Matt asked. Tyler shrugged. Probably. I'll figure it out later. Matt didn't push it. He knew that answer. He had given the exact same answer 3 months ago. He just never said it out loud. I'll figure it out later means never. Not because someone is lazy or irresponsible. Simply because the moment that first bigger paycheck hits, you look at the total amount, you get a rush of dopamine, you close the app, and you go on living your life. And the $480 is quietly siphoned off 2 weeks later, when the euphoria has faded, but your attention hasn't returned to the details. Tyler flipped through the rest of the contract, barely looking at it. Matt looked out the window. He thought about how he could explain everything Ryan had told him. He could break down gross versus net. He could explain the fully loaded employer cost. He could tell Tyler that out of his $85,000, he's actually going to take home about $60,000. And that's before the $480 monthly HR drain kicks in. He could explain amortization and how that new Tacoma on a 7-year loan was going to cost him thousands more in front-loaded interest than the sticker price suggested. But he didn't say any of it. Not because he didn't want to help, because he knew a person only truly hears the advice they are ready to seek out themselves. 2 weeks ago, Matt was staring at a cleaner's pay stub, and that was his entry point. Not a lecture, not an article online. His own shock, his own question. Tyler folded the contract and put it in his bag. Anyway, looks solid to me. I start on the 15th. Congrats, man, Matt said. Good luck out there. They drank their coffee, talked about their parents, plans for the summer. Tyler left in a great mood. Matt stayed at the table. He pulled out his phone and opened the spreadsheet he'd started after his meeting with Ryan. Not a budget spreadsheet. He called this one the real numbers. It had 4 columns. Column A, nominal salary, the gross number on the contract. Column B, net pay, what hits the bank after federal/state/FICA. Column C, fully loaded cost, what the employer actually pays to keep him. Column D, true retained cash, what's left after hidden bank fees and automatic HR opt-ins. His row looked like this: $100,000, $69,600, $130,000, $69,600. His last column matched his net pay now, because he had canceled the $45 life insurance, paused the $100 FSA, and waived the $12 bank fee. He had plugged his leaks. He added a 5th column, yield percentage. He divided his true retained cash by the employer cost, 53.5%. For every $100 generated to pay for his labor, he gets to direct $53.50. The other $46.50 goes into the machine before he ever sees it. It wasn't theft. It wasn't a scam. It was just the rules of the game that he had never bothered to read. He added a row for Tyler. Nominal, $85,000. Net, roughly $60,000. Employer cost, $110,500. If Tyler doesn't log into the portal and opt out of those premium plans in his first 30 days, his true retained cash drops to $54,240. His yield percentage, 49%. The system makes no exceptions. It doesn't matter if you're an architect or a site inspector. It doesn't matter if your salary is $85,000 or $100,000. The mechanics work exactly the same way. Matt closed the spreadsheet. He looked at the empty chair where Tyler had been sitting. He thought about how in a month Tyler would get his first paycheck. He'd see $2,300 instead of the $3,200 gross he was calculating in his head. He'd probably be surprised, even though everyone knows about taxes in theory. Maybe he'd go in and cancel the premium insurance. Maybe he wouldn't. It was his path to walk. Matt put his phone away. Outside, it was a quiet, breezy May afternoon. He thought about how, just a few months ago, he looked at his finances like a facade. Beautiful, easy to understand, everything in its right place. And then he realized that behind the glass, there were floors and floors of mechanical systems, plumbing, and wiring that nobody showed him, but that had been running the entire time, flawlessly, by their own rules. He stood up, took his cup to the counter. He watched the barista rinse a pitcher. He realized that an architect who doesn't read the structural engineering reports eventually builds a house with a cracked foundation. Not because he's a bad architect, simply because he was looking at the wrong piece of paper. In early June, Matt got his paycheck. He opened his banking app, a habitual motion, like opening a window in the morning just to let the air in. The screen showed $2,900 for the 2-week period. The exact same number as back in December, when he stood by his window and thought everything had finally fallen into place. But now, next to that number, 3 other numbers existed in his head. $5,400, what the firm paid to employ him for those 2 weeks. $3,846, his gross pay on paper. $2,900, what actually arrived. There were no more hidden leaks, no $12 bank fees, no $45 ghost insurance policies. He sat at his desk with the same piece of paper he'd used in March when he was desperately searching for a math error. Back then, he was looking for where the money was going. Now he knew the answer, not approximately, but exactly, down to the last dollar. It wasn't life-changing money he had recovered, Saving $150 a month doesn't make you rich overnight. But Matt looked at those numbers and wasn't thinking about the amount. He was thinking about the fact that he hadn't known the rules, that he had signed contracts without reading them, that he had stared at one single number on an offer letter and built his entire financial reality around it. Like an architect who only sees the facade. He opened his spreadsheet. He added a new section. Not about what was leaving, but about what he could keep. Tax optimization. He had never adjusted his W-4. For 3 years, he had let the government overwithhold his taxes, taking hundreds of dollars extra out of every paycheck, just so they could hand it back to him as a refund in April. Ryan had explained it perfectly. A refund isn't a bonus. It's your own money being returned to you after you gave the IRS a 0% interest loan for a year. He logged into his payroll system and adjusted his withholdings. That alone was going to put another $150 back into his monthly cash flow. At the bottom of his paper, he wrote one final line. The real takeaway wasn't in dollars. It was this. Before, I looked at one number. Now, I see 4. That was the difference. He put his pen down, walked over to the window. June in Chicago is beautiful. The trees are thick. The air is warm but not yet suffocating. He looked out at the street and remembered his conversation with Ryan at the coffee shop. Nominal versus effective rates. Amortization. Compound interest. Back then, it sounded like someone explaining the mechanics of a foreign machine. Interesting, but abstract. Now, it was his own machine. And he finally had the instruction manual. He remembered November, the glass conference room, the smell of cheap coffee, David saying, starting December 1st, $100,000. The physical relief. Calling his mom. Thinking everything was solved. Nothing was solved back then. Because he was looking at the wrong metrics. Not because he was naive or careless. He was a smart, precise, analytical guy who spent every day looking for stress fractures in concrete and calculating weight loads. He just never requested the full set of blueprints for his own life. He looked at the facade and assumed it was the whole building. Now he knew there was a cross-section, and a floor plan, and an electrical schematic, and you have to read all of it. A car drove by outside. Then it was quiet again. Matt stood by his window, the same window as in December, looking out at the June street. The number hitting his bank account was exactly the same. But now it was accompanied by the invisible numbers he had mapped out himself. And that changed everything. His luck didn't change. His salary didn't change. His boss didn't change. What changed was the language in which he read his own money. Let's stop here and be direct. Matt's story is about an architect, but really, it's a story about anyone who gets a paycheck and has never looked past the single bold number on their offer letter. Gross and net. Fully loaded employer cost. Nominal versus effective rates. Amortization schedules. Compound interest. Auto-enrolled HR benefits. This isn't complex calculus. It's just the rules of the game. Rules nobody explains to you. Not because it's a massive conspiracy, but because nobody ever asks. Take your base salary and multiply it by 1.3. That is the true cost of your labor. Then look at what actually hits your checking account. Then open your HR portal and look at your pay stub deductions. Just look at them. If the difference between that first number and the last number surprises you, drop one word in the comments. Calculated. I'll know you watched until the end and saw the building, not just the facade. If you want to understand the actual mechanics of money, not just motivation and theory, but the literal systems that drain your cash before you even see it, subscribe to the channel and sign up for the newsletter in the description. We're going to read the blueprints together.